Today, I'm going to show you an example of how we help someone withdraw £60,000 a year completely tax-free. No, it's not magic, it's tax planning, and it's ensuring your money is invested in the right products that help you maximise and utilise your legitimate tax allowances in the UK. To do this, you need to make sure your money is invested in the right products at the right time to ensure maximum tax efficiency. This is both for growth and for income at the time that you need it the most. Most people assume they'll be paying tax in retirement, but what if I showed you there's a way to structure your withdrawals so that you keep most of your hard-earned money? In this video, we will demonstrate a simple formula that allows you and your partner to withdraw tax efficiently without any complicated tax loopholes. A lot of people get this wrong and make the wrong decisions to either get to this point or at retirement. It's also worth noting that this is assuming there is no other income in the household, and this is not suggesting that this is the right plan, advice, or idea for you. It's just an example of how an income option can work in retirement. If you're considering accessing pensions, we always recommend that you seek financial advice before making any large decisions. One more note of caution is that once you access your pensions flexibly in this manner, your ability to make future pension contributions is severely reduced. Step 1. Pensions. This assumes you have a defined contribution pot with flexible withdrawal options. Not all pensions facilitate this, so you need to ensure this is an option and that it's suitable for you. The key number per person is a withdrawal of £16,760. This comes from a mix of taxable income and tax-free cash, known as an UF+, or in full, an uncrystallised funds pension lump sum. Here's how it works. So 75% of that withdrawal equals £12,570. And that uses all of your personal income tax for the year 25-26 allowance, which means it's tax-free effectively. The other 25% is tax-free cash, another £4,190. So together, that's £16,760 of tax-free income from your pension. And that is per person. So if you're married or have a partner, you can double it to £33,520 tax-free per household. Step 2, ISAs. So to reach the full £60,000 target, we now need to fill the gap. If both of you have ISAs, you can withdraw as much as you like without any tax implications. And if you've built up a decent pot over the years, using your annual allowances, which are currently £20,000 each, you might be able to draw from the interest or gains and keep the actual capital intact. For example, if a couple drew £13,240 each from their ISAs, that's an additional £26,480 in income, and that then added to the £33,520 from pensions would give the household a total income of £60,000 tax-free. Okay, so now let's talk about the biggest mistake people make, and it's simple. Either they don't save enough into pensions and ISAs, or they don't manage their tax position. So a couple of really useful tips for you. Always use your ISA allowance if you can, even if that's just cash for now, because you can always transfer it into an investment ISA later, and this way you don't lose the allowance for that year. The sooner you start, the bigger your ISA pot will be. You'll also benefit from tax-free growth on the way in and tax-free withdrawals on the way out. And don't forget your pension. Yes, short-term spending can feel more urgent, but most of us are living long, healthy lives, so you need to plan for it. Every pound that you pay in gets tax relief and it grows tax efficiently. It's there for when you need it later on. So, here's the questions. Are you making the most of your allowances? And do you know what your retirement will really cost you? This example shows you how you might structure your income to reach £60,000 tax-free, but whether this level of drawdown is sustainable for you depends on a number of factors, like the size of your pension and ISA pots, your lifestyle needs, your risk profile, your working plans and arrangements, and how your investments perform. That's why it's so important to seek independent financial advice before making any decisions. If this strategy was an eye-opener for you, please leave a comment or a question below. We'd love to help. And if you want more financial planning insights to keep more of your money and retire smarter, then please hit subscribe. Thanks for watching.